What's going on, everybody? Welcome back to Ryan Makes Sense. Today we're looking at Chegg, ticker symbol CHGG. We're going to go ahead and see what institutions and hedge funds are doing. Are they buying or selling? We're also going to look at some advanced charting on Thinkorswim. And looks like we've done this before, so we'll go ahead and see where we're at nowadays. So let's jump in. Let's also calculate and see if the stock is actually worth $1.60. Should it be worth more or less? And we'll look at some other trends on the balance sheet in these financial metrics to see what in the heck is going on. So without further ado, let's shrink our heads. That's good. Okay, so we can see Chegg used to be 115 bucks. Now it's $1.60. The strength is with the bears. Momentum. Now momentum, it looks like it is, whoops. Actually, it looks like it's kind of coming back up. You guys can see that, right? Like a little whoop. We'll see. Money flow looks like it is heading down towards the bottom of the ocean. But we'll go ahead and double check that on our institution and hedge fund activity up here. And then again, our relative momentum already below the bottom of the earth, scraping all the sediment. So yeah, this one looks dead, which can be good, can be bad. We'll determine to see how this company is doing. So first and foremost, this is good right here. You can see there used to be 136.9 million shares in 2021. 2023, there's 102 million, and now we're in 2024 and there's still 102 million. So there is natural and organic accumulation of the shares. This looks not so good. It's still showing 2023 down here, so we're gonna have to double check and make sure that they are submitting their financial data. Okay. So we can see it's up and to the right. This is all good. Then it starts to plateau down. 2023, 716 million. 2024, we're at 683 million. So it continues to move down drastically. So I don't know if they're working on that. We're going to find out. Quick ratio is a 0.89, not bad. One of the biggest red flags I'm kind of seeing right now is they make 683 million, but they're losing 626 million. Gross margins are high, so every $100 they spend, they get $173.21 back. So that is good. Some shorting going on. Earnings per share past 5 years negative, sales past 5 years positive. So we're seeing a little bit of mixy match there. Debt to their long-term debt, they're actually addressing that. So it looks like their debt is going down. So this is good news. Institutions own 92%. We're going to fact check that and validate, because if this company is really turning around, we should see this be higher. Again, they're far from profitability, unfortunately. So yeah, let's run the numbers here. This might be a really ugly, we might not even be able to forecast a stock price if the debt outweighs the cash. So for income, they do negative 626,920,000. Not good. Sales 683,340,000. Okay, let's go on down. Down. Okay, Q1 2024, 174 million. Q1 2023, 187 million. So they're down about 13 million there. They spent 3 million less. Gross profit down 11 million overall. Q2 2024, 163 million compared to 182 million the year before. Almost a $20 million increase. They spent less than 2 million. They spent less than 2 million than they did in 2023. Gross profit down about 17 million. Gross margins 72, 73, 75. So the gross margins are generally really good. And they're not really getting beat up. I thought they were going to get beat up here where they're spending a lot to make not that much, but you can actually see they're spending 45 million to make 163 million. again, that's a really good margin right there. Oh, mamacita. Oh, geez. Negative 616 million net income. This is really going to reflect negatively for the next 4 quarters. And this looks like a one-time charge off. Because if you look at the trend here, the trend for each quarter, there's nothing that is like this. So that is insane. But also, if this is going to benefit their business, we could be at the pinnacle of a turnaround. So let's keep going. Overall, not looking too horrible. They have 346 million in cash. I hope that holds up. 346 million flat. Okay. Debt. Their debt is not that bad. They have drastically reduced their debt. Ooh, I'm excited for this next piece I'm going to talk about, but just give me a second. Debt is 258,670,000. Okay. Now, I'm going to really quickly. Assets 1.1 billion, total liabilities 748 million. Assets dwarf liability is about 1.5 to 1. So every liability they have 1.5 assets, which is good. However, their assets decreased 618 million, while their liabilities only decreased 21 million. So huge decrease in liability here, quarter over quarter from Q1 to Q2. Overall, this is not bad. Really. I wonder what that one-time charge off was. Let's see, 20. I don't know if I'm going to be able to find it here. So that was on the latest earnings call, which was no, actually that was before November. So it'd probably be August. Okay, so they beat their earnings. That's good. But the stock went down, probably because of the one-time charge off. Let's see what it is. I really dislike when articles don't really give us information. Hoping Yahoo Finance does. We'll let that load. But really, I'm not seeing any specific. I'm not seeing any specific pieces that are attributed to that negative 660 million net income loss. Service subscribers 4.4 million. Okay, so they have a subscriber business. Okay, restructure. They completed their restructure. Okay. Yeah, I really think this company is at a turning point, honestly. Um, they're having issues growing the subscriber base. Okay. Key takeaways. Okay. So they finished their restructuring, so that could be what that 600 million negative net income charge off was. I'm surprised it doesn't note anything down here. So anyway, back to this. We have 102,820,000. So we're getting a projected stock price of $1.40. The stock is at $1.60 right now. And really, I think this might be the pivot point for this company. And I do say that because they also noticed they're fixing, they're restructuring. This net income is going to be a black eye on them for the next, again, now 3 quarters. So November 12th, and then likely February 25, and then again August or September of 25. This is going to reduce drastically. Sales are also falling at the same time. So they really haven't hit their stride in terms of growing their subscriber base, being profitable, and really being a well-oiled machine yet. Do I think they can get there? I think so. I mean, let's just look at Chegg here and load it. I think they could. And their company, their financials, their metrics are not the worst. Yes, this is a penny stock, but I think if we give them time, I mean, their quick ratio, I think their quick ratio is improving. Their debt's improving. Quick ratio um, used to be really good, going downhill big time, increase there, slight decrease. So they're really, really trying to hit their stride here. Um, this is good, but I don't know if this is the time to get in. Let's see. Okay, so Chegg. Okay, so interesting. I mean, it's education based. Okay, not bad. Institutions own 92%. My calculation says the stock should go lower. Analysts have a price target of 280. Morgan Stanley had this at 325. I'd say this should probably be going down. My price target's 140. 92% is old data. 98% is new data. So we are seeing, let me just blow it up. We are seeing an increase of institutional and hedge fund ownership here, which is good. But let's see what the big boys and girls are doing. Looks like BlackRock may have added. See, this is so weird. This website, it looks like they had 10 million shares. Now they have 7.4 million shares. So did they sell? I would think they did. Unless they added, so they have 17 million. This website's not 100% clear. I think we could take it as potentially BlackRock selling and it just not registering this website. DE Shaw 5.6 million shares. Silbra Capital 9 million. Vanguard sold 4 point whatever 4% earlier this year, and then Bally Gifford sold 56%. So overall, we are seeing an increase. Like I said, new data is 98.15%. Old data is 92. So we are seeing a 6% increase. And we also saw that the chart here is slightly up. Okay, in terms of price targets. Okay. Um, what we have here is I have Fibonacci cycles, I have arcs. I also have supports and resistances. So this would have been the time to buy. This would have been the time to sell. This will be the time to buy. This will be the time to sell. That is the general pattern on this. Very simple. It's stupid simple. So it's not saying we're at a low yet, although we are below our all-time, we're at all-time lows now, basically. So in terms of supports and resistances, the stock is 160. You can see we are literally right on this line as we speak. I mean, if the company has amazing earnings in November, by the time this video is out, we're going to be looking for $3.13 to $3.20. Um, I don't know if we're there yet. No. $1.48 could be our potential low. And I only say that if we look at this Fibonacci arc here, this pattern, this one that I'm hitting, you can see it highlight, highlight, highlight. You can see the candles respected this very well on the way up. So on the way down, we can see, I'll just make it a different color so people can see it a little bit better. Okay, looking at the purple rings here, this stock respects it very well. You can see perfect support, falls through, perfect support, perfect, almost perfect resistance. So that's with a forecast of a potential low, again, on our cycle area. Buy, sell, buy. And that's coming post 2025, which if this company, I mean, if they report well on November, that would be the turnaround. That would, I think maybe taking a small bite before November. If the company is still working through their issues in November, let that bad sentiment, let the stock go down until it finds consolidation. Maybe consider taking two more nibbles down there. Then in February or March, when they have their next earnings release, if they are turning around, maybe take another bite. Really just depends how optimistic you are on this type of company. Um, I mean, for myself, are people going to college as much as they used to? Because this is a very college education based website. Um, I don't think insiders are buying, are they? They're not. However, hedge funds are buying. So a little bit, it's kind of a mix. Uh, this is just a temporary black eye. Again, as time goes on, 1 year from now, they will probably be profitable or almost profitable. Actually, let's go see. Were they profitable before? Nope, they were not profitable for a trailing. Okay, they were profitable the end of Q 2023. Looking at the trailing 12 months here, you can see that they were barely profitable. They were very profitable 2022, and they've hit some woes. And then this piece, I'm guessing, is part of the restructuring, finishing the restructuring item. So yeah, once 4 quarters from now, this will be a distant memory, and I think Chegg might be looking good. So they really have about 1 year to turn their butt around and really look solid and get back to profitability. For this next year, I mean, just definitely stay on the sidelines, in my opinion. This for traders and swing traders who scan for stocks based on net income, this black eye here is going to last for 3 more quarters, unfortunately. So this will be under the radar. The benefit of watching this video is this company really could have hit the turnaround this year, this Q2 of 2024. As long as they continue to improve going forward, which based off of the restructuring that they did, that is looking true. However, let's see. Let's see. People attending college overall in the USA past 10 years. Let's see. Okay, so that kind of aligns with what I said. People attending college in the USA has declined over the past decade, with overall college enrollment dropping around 7% and peaking around 2010. Um, Several factors, yes, costs obviously. So, yeah, that's where we're at. So Chegg, we're just looking at the website again. I do just want to see what they offer. They offer books, homework help, learning lab. Do they have an extensive library of certifications or courses? Um, Not really. I was looking for like a Coursera or Course Hero type thing, but this is more so about schoolwork. Not really what I was expecting. For educators. So, yeah, it really depends how optimistic you are about college, but definitely sitting on the sidelines for this one. Again, 2022, they had really strong, where was it? They had really strong net income here. Um, but yeah, their Q4s are just declining. So I'm on the side. We'll see how this goes. It looks like the company really is trying to turn things around. Um, this quarter, Q2, was a big turnaround quarter for them. So, yeah, I mean, other than that, this company is gonna look solid. Their forward PE is very low. Their quick ratio is almost one, which is fantastic, which is what we need to see. EPS looks like it's positive 15% next year. Again, good organic and natural share accumulation here. Um, I'm on the sidelines for sure on this one. Just gonna see how it goes for the next quarter. But if you made it this far, consider subscribing. Let me know your thoughts on this. Are you optimistic about people returning back to college? Are you optimistic on Chegg? Let me know what you think. Adios.